Hey everyone, it's Alex Morgan here, and today we're tackling one of the most serious and controversial questions in the entire precious metals world. Should you sell gold and silver if the monetary system collapses? This is not clickbait. This is not fear-driven hype. This is about strategy. Because whether you believe we're heading toward a gradual currency reset, a sovereign debt crisis, a banking shock, or simply long-term inflation erosion, understanding when to sell gold and silver is just as important as knowing when to buy. Let's slow this down and think clearly. The phrase monetary system collapse gets thrown around constantly. But what does that actually mean? Historically, monetary stress doesn't look like Hollywood. It doesn't usually mean cash instantly becomes worthless overnight. More often it means debt becomes unsustainable, currencies lose purchasing power, confidence in institutions weakens, and policymakers respond with aggressive liquidity measures. Right now, global debt levels remain historically elevated. Major economies continue running structural deficits. Central banks expanded balance sheets massively over the last decade. Inflation, although no longer at peak panic levels, remains structurally above long-term norms in many regions. Real interest rates fluctuate, but policy uncertainty remains high. In this environment, gold and silver have behaved exactly as they tend to behave during monetary stress cycles: volatile, but structurally supported. Gold has remained elevated relative to multi-year averages. Silver has experienced stronger swings, typical for a smaller, more industrially sensitive market. Neither metal has collapsed. In fact, both continue to attract capital whenever financial stress rises. But here's the key question. If the system truly destabilizes, do you sell? The honest answer is, it depends on what phase of the crisis you are in. Let's walk through the phases of monetary breakdown historically observed. Phase 1 is fear and liquidity demand. When markets panic, everything sells off, even gold and silver. Investors rush to cash. We saw similar behavior in past financial crises, where even safe haven assets initially dropped as liquidity became king. Phase 2 is policy response. Central banks inject liquidity, cut rates, expand balance sheets, and reassure markets. At this stage, precious metals often begin rallying strongly because currency debasement fears rise. Phase 3 is confidence erosion. If public trust weakens and inflation accelerates, gold and silver typically enter stronger upward trends. Phase 4 is stabilization or reset. This can involve new monetary frameworks, policy tightening, or gradual normalization. So when should you sell? If you sell during Phase 1 panic, you risk exiting at low prices just before metals rebound. If you sell during Phase 2 liquidity expansion, you may miss explosive upside. If you sell during Phase 3 inflation acceleration, you might exit during peak momentum. If you wait for Phase 4 stabilization, metals may already be rolling over. Timing is everything. Let's bring this into the current macro context. Central banks today remain highly sensitive to growth slowdowns. Bond markets are volatile. Currency markets show stress in emerging economies periodically. Precious metals have seen renewed institutional interest, especially through ETFs and central bank buying patterns. Silver, unlike gold, also has strong industrial demand components: solar energy, electronics, electric vehicles. That means silver's trajectory during monetary stress may diverge depending on economic conditions. If collapse means deflationary contraction, silver could underperform gold initially. If collapse means inflationary debasement with continued green infrastructure investment, silver could outperform. Now consider investor psychology. If the monetary system truly destabilizes, gold and silver are not just investments, they are confidence hedges. Selling during maximum uncertainty may feel safe, but historically that has often been when metals ultimately reprice higher. However, holding blindly without strategy is also dangerous. You must define what collapse means to you. Is it hyperinflation, banking insolvency, sovereign debt restructuring, digital currency transition? Each scenario has different implications for metals pricing. In hyperinflation scenarios, gold and silver prices often rise sharply in nominal terms, but liquidity, taxation, and transaction friction become major issues. Selling might become logistically difficult. Physical metals may trade at premiums. Governments might introduce capital controls. In deflationary banking crises, gold can drop initially as cash demand spikes, then recover strongly as policy stimulus floods the system. In digital currency transition scenarios, gold may remain a hedge asset, but price volatility could increase dramatically. So what could happen next? Short term, precious metals remain sensitive to interest rate expectations and real yields. If central banks pivot toward easing, gold could strengthen. If real yields rise sharply, gold could temporarily weaken. Silver's direction may depend on both monetary expectations and industrial outlook. Medium term, structural debt pressures favor continued volatility. Confidence cycles drive metals markets more than headlines. Long term, gold historically preserves purchasing power across systemic transitions. Silver amplifies the cycle but carries higher volatility. So should you sell if the system collapses? Not as a reaction. Selling should be part of a predefined strategy, not an emotional decision triggered by fear. Some investors plan staggered profit-taking if gold reaches certain multiples of historical ratios. Others allocate a fixed portfolio percentage and rebalance rather than fully exit. Some hold a core position indefinitely as insurance. Insurance is rarely sold at the first sign of fire. If you own metals as insurance against systemic risk, you don't liquidate during instability unless your thesis changes. If you own metals as a trade, your exit depends on technical and macro signals. Let's talk numbers conceptually. If gold breaks into sustained uptrend territory with accelerating momentum, that is not typically when long-term holders exit completely. It is often when speculative inflows increase. If silver enters a parabolic move driven by monetary fear and industrial demand, volatility will spike. Those are conditions where disciplined scaling out may make sense. But panic selling during initial systemic fear historically has not been a high-probability strategy. Another angle is taxation and regulation. During monetary stress, governments often adjust fiscal rules. Capital gains taxes, transaction reporting requirements, or even windfall measures can appear. That risk must be considered when planning exits. Also consider liquidity. Physical gold and silver require access to markets. In severe disruptions, spreads widen. Dealers adjust premiums. Timing liquidity becomes critical. Paper metals, ETFs, futures, behave differently from physical bullion. In extreme stress, they may not perfectly track spot premiums. This is why diversification of format matters. Now let's imagine 3 realistic forward paths for gold and silver from here. Scenario 1. Gradual inflationary erosion. Debt continues rising, central banks maintain accommodative stance, inflation remains above target. In this environment, gold trends upward slowly. Silver follows with volatility. Selling too early could mean missing steady appreciation. Scenario 2. Deflationary shock followed by stimulus. Metals drop initially, then surge as liquidity floods markets. Selling during the drop would be premature. Selling into the liquidity-driven rally may be strategic. Scenario 3. Severe confidence breakdown. Rapid currency depreciation, capital controls, banking stress. Metals spike in nominal value. At that point, selling portions to rebalance into real assets like land or productive assets could make sense. Notice the pattern. Selling is strategic during strength, not fear. But here's the nuance. If metals become an extreme percentage of your net worth due to price appreciation, portfolio concentration risk increases. Rebalancing may be prudent regardless of collapse narrative. Another question to consider, what are you selling into? If you sell gold and silver, what asset do you trust more? Cash, bonds, real estate, equities, alternative currencies? Selling metals during monetary instability without a superior alternative defeats the purpose of holding them. The decision is comparative, not absolute. Gold and silver are not designed to outperform every asset in every environment. They are hedges against monetary disorder. If the system collapses in a way that eventually stabilizes under a new framework, metals may peak before the new system consolidates. Recognizing that transition phase is key. So here is the practical approach. Define your allocation target. Define your rebalancing threshold. Define what macro signals would invalidate your thesis. Define how you would liquidate, physical or paper. Do this before crisis, not during it. Right now, markets remain in a fragile but functioning state. Precious metals reflect caution, not panic. There is no confirmed collapse, only elevated structural risk. If monetary stress increases, expect volatility spikes in gold and silver. Short-term corrections will occur even within bullish cycles. Emotion will be your biggest enemy. Remember this. In systemic transitions, price is not the only variable. Liquidity, policy response, taxation, and confidence cycles matter equally. Gold and silver are long-term monetary hedges. They are not lottery tickets. If you sell, do so because your thesis matured, not because headlines frightened you. And if you hold, do so with discipline, not blind faith. Markets reward preparation, not panic. If you found this deep analysis helpful, hit that like button so more people can see it. Subscribe for serious, data-driven discussions about gold, silver, and the global monetary system. And drop a comment below. Would you sell, hold, or buy more if the system destabilizes? This is Alex Morgan, and I'll see you in the next video.